Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about how to use the pivot points that as a tool to improve your trading performance, okay? To catch low risk, high probability trading opportunities. So, first things first, without wasting any more of your precious time, what exactly are pivot points? Okay, what exactly are pivot points? I know if you've been trading for any length of time, or if you've been trading for a while, I would say you must have come across pivot points at some point in your trading career, because they're actually widely used by a lot of traders. And for you to use them, you actually don't need to know what they are, because most times you'd hear traders just making reference to pivot levels, and if all you wanted to do was just to use them to trade, then you wouldn't really need to know them to use them. But like with anything I like to teach in trading and like to implore you guys to use, it helps to understand the logic and the concept behind whatever tool you're using. Because when you understand that, even without knowing the kind of seeing the tool on your charts, you can put two and two together and understand how it's going to relate to how you're going to be trading. And that's one of the reasons why most of these classes that we host during this ITU Forex class, most of the topics that we host during these classes, you'd see me talk about tools, but then we would actually look at what makes the tools tick. Okay, the concepts behind them, the logic behind them, and all of that before we talk about how to use them. Because when you understand the logic or the concept or all of those things that make them tick or why you're using them, then it actually makes it make sense for you to use it. Okay? And so what exactly are pivot points? So in plain simple terms, pivot points are just pre-calculated support and resistance levels. Okay? So what do I mean by pre-calculated? So to help you understand this, the way pivot points work is they are actually levels that predict where markets are likely to get reactions in. But they don't just do that, randomly. They are based on a formula. And this particular formula is going to be using either the opening price of the instrument you're trading, that's on the daily time frame, the opening price of a candle, the closing price of a candle, the high price of a candle, and whatever. And these are kind of made into a formula that would predictively tell you where you're likely to get resistance during the day, during the session. And so it's going to calculate all of this for you. Okay, so let's look exactly at what the formula looks like. As you can see, this is exactly what the pivot points formula looks like, okay? So from the little snippet we have here, you can see that pivot points, that's PP, most times you'd see it with the short form as PP. This is the central pivot points. Most of the times you'd have the PP, the central pivot points in the middle of whatever other pivot lines are going to be plotted, okay? And so it's going to be in the middle, it's going to be in the center, and then above that pivot points, you're going to have the R1, which is the resistance one, then you have R2, R3, and so on and so forth, okay? And then below the central pivot, you're going to get the support 1, support 2, and support 3. Okay, now what you're seeing here from the snippet is the formula which is used to compute this number. Okay, so even without having an indicator that helps you to plot the pivot points on your chart, you can just plug the values that you need here and then calculate them manually and just drag and drop lines on your chart to represent the levels. It's just that having a technical indicator, a custom technical indicator that is going to do that for you will make things so much easier. Okay, so moving on. The central pivot point, how is that value, how is that price level computed? Well, it takes into account, as you can see from here, the H that you're seeing here is the highest price of the previous day's candle. Okay? The L you're seeing here is the lowest price of the previous day's candle. And C here is the closing price of the previous day's candle. So if you wanted to get the value, the numerical value, the price level of the central pivot point, you're going to have to add the highest price of the previous day's candle to the lowest price of the previous day's candle and the closing price of the previous day's candle, and then whatever resulting value you get from this, you divide that by 3. And when you do that, the resulting number you're going to get is going to be the value for your central pivot point. Okay, pay close attention, because everything we're going to be talking about regarding pivot points is going to be centered upon what we just talked about here. Okay, the formulas. Okay, so like I told you, we have the central pivot point in the middle, and then above it we've got the resistance, predictive resistance lines of the pivot point. We've got R1, and R2 is just above the central pivot, but it's also below R2. R1 is above the central pivot point, but it's also below R2. In the same vein, R2 is above the central pivot and it's above R1, but it's below R3. Okay? Now, what about the levels that are under the central pivot? Those levels are called the support levels. And just like we have R1, R2, and R3, we also have S1, S2, and S3. And all of these levels that you're seeing, they've got the formula for calculating each one of them using the values of the previous day's high, low, open, or close. So, in the case of R1, how is it calculated? What's the formula for calculating R1? Well, for that, we're going to multiply the central pivot. That's the value we get for the central pivot point. We're going to multiply that number by 2, and then we're going to subtract the value of the previous day's low to get the value of R1. How do we get the value of R2? We're going to multiply the value of the central pivot points, which we got earlier on, by the number 2, and then we're going to subtract the value of the previous day's high from the resulting number that we get. How about R2 and R3? R2 and S2. The way we get the value for R2 is the central pivot point is going to be added to the resulting number we'll get from subtracting the previous day's low from the previous day's high. The same thing. To get support level 2, we're going to be subtracting the resulting value from H, that's the previous day's high, and the previous day's low, and then we'll subtract that from the central pivot. And then R3, you can see that we would add the highest price times, we'll add the highest price of the previous day's candle, and we would add that value to the resulting value of 2 times central pivot minus low, or R2 plus H minus L. Now, in a nutshell, this does not mean that you need to memorize these formulas for you to use the central pivot, or for you to use pivot points, in short, okay, to identify low risk high probability trading opportunities. Like I told you, the reason why I'm doing this is because I want you to just have a kind of an understanding of what the lines you're seeing on your chart represent. Because if you do understand them, then it's not just going to look like something, like some voodoo thing on your chart that you don't even know how to use. Okay, so let's go back to the charts and see how these levels interact with price action. Okay, so this is a chart which has the daily pivots, okay, on the 15 minutes time frame. The blue line you're seeing here is the central pivot point, and you can see it's called PP, right? Central pivot. While R1 is the first resulting resistance line. Remember, I told you that R1 is directly above the central pivot, while S1 is directly beneath the central pivot. S1. Now we've got R2, which is directly above R1, and it's also above the central pivot, while S2 is below the central pivot and it's also below S1. Okay, and then we have R3, which is above R1 and R2 and the central pivot, and S3, which is below S1 and S2 and the central pivot. Okay, now what does this have to do with anything? Well, the way traders use them to trade varies a lot, because some traders just go with the notion that if price is trading, let's say at the end of the day, you've computed all of these numbers using the formula, and then you saw that price is trading above the central pivot, then some traders believe that if that is the case, then they would be looking to short the market when price bumps into the resistance areas of the pivot point. Okay, while other traders believe that if price is trading below the central pivot, then whenever price comes to support, they will be looking to go long on that particular instrument. Now, for this particular example, you can see that on this particular day, if you used this approach, this would have worked well for you. Because look, price opened above the central pivot. You can see it from this candle at the end of this close, okay? Price opened above the central pivot. And then when price bumped into R1, you can see that we had rejection here. So maybe you could have taken a short trade here, and maybe the first trade would have been a loser, but then the second trade would have held clearly because this resistance area would have held. So if you're using proper risk management, good risk to reward ratios and all of that, then you should be fine, okay? But I personally don't like to use it the way traders use it like this. And there's a reason behind that. The reason is because I believe you can't just, even though some traders do, personally for me, this is a matter of preference. I just don't feel like, just blindly buying or selling an instrument because it opened high or it opened lower than a certain price point is the way to go. The reason is because I believe there's information in price action. And so I lean towards the side of waiting for price to come to these levels and then watching how it reacts to the levels before taking a direction or taking a bias in the market. So what does this mean? For me personally, you can see that like on a day like this, price would have opened above the central pivot. Clearly, you would have seen this. Now, if we were trading based on the basics of traders that, they just wait for price to go to the resistance area if it opened above the central pivot and they just short, you would have never gotten an opportunity here. Not that that is a bad thing, but I just personally prefer to see how price reacts to these levels before I take a position in the market. So in this case, you can see that price was nowhere here. It was nowhere near any pivot point. So we would have not done anything. But then if we sat and waited on our hands for price to come all the way to this particular central pivot and see how it reacted to the level, you would have seen that, okay, price slightly broke below this level, but then that break was not clear. It wasn't decisive. Okay. And so immediately this break was kind of like a fake out. So it broke this level, but then it immediately got back, going back up to the upside. So when we got this break back up and then price got rejected at the formation of this, what do you call it? This hammer candlestick and then the formation of this bullish engulfing candlestick. This could have been a cue for you to take a trade to the upside. Okay, this would have, most times when traders are trading with pivot points, these trades are intraday trades. Okay, so this would have been a simple scalp trade where you just take a long trade or wait for price when it came back here, just take a long trade, risk whatever you're risking with a tight stop loss or whatever the case might be. If you're going aggressive or conservative, all that depends on your preference, and then aim for a 1:2, simple 1:2 risk to reward ratio trade, and this would have been a winning trade. Now, does this mean that every single trade you take based on this approach is going to be a winner? Of course not. And I've made it pretty clear on this class is that even the strategy, which is my flagship strategy, my go-to trading strategy that I use, most of the times I win, let's say about 45% of the trades I take. And this is after taking a large number of trades, like 100 trades or whatever the case might be. But it's still profitable. And why is that the case? That's the case because when I'm trading with the strategy, I also use proper risk management, because even if a trading strategy gives you 90% win rate, if you're not coupling that particular trading strategy with proper risk management, you're still going to find it difficult to make money through trading. And so the way you do this is when you have a strategy that gives you an edge over the market, you also want to amplify that edge by coupling it with proper risk management. So if you're trading the strategy, you'd be risking a consistent amount whenever you find a trade setup. So for example, if you're taking trades, you might be risking 1% of your account's capital on each trade you take. But that's not all, because simply risking 1% is not all. You might be risking 1%, but if whenever you make a profit, that profit on average is smaller than what you lose from your losing trades, then you're still going to find it difficult to be profitable. So what you need to do is you need to keep your risk consistent, which is what we advise you guys to do by recommending that you never risk more than 1% of your trading account's capital on each trade you take. And then the second thing is you should trade with a positive risk to reward ratio if possible. Okay, positive risk to reward ratio simply means you're aiming to make more than you're losing on your losing trades on average. So if you're trading with a 1:2 risk to reward ratio, for example, whenever you risk 1%, you're aiming to make a profit of 2% on the trades you win. When you do it this way, after taking a large number of trades, even if you were to lose half of the trades you took, because of this risk management hack, coupled with the edge that your trading strategy gives you, you're going to find it easy to end up being profitable. Okay? So moving forward, let's look for another example to illustrate what I'm saying. Okay? So again, I want you to come to this example with an open mind, because like I told you earlier on, there's no approach that is perfect. My approach, where I say I lean towards waiting for price to come to a pivot point and then seeing how it reacts to the pivot level before taking the trade, that does not mean that because that's the approach I lean towards, that it works 100% of the time. In the same vein, the traders that wait for pivots or for price to come to resistance pivot levels for them to take trading opportunities, shorting that pivot or whatever, that does not mean that whenever they take a trade, it's also going to be 100%. And that's why risk management is important, okay? Because as long as you don't know with 100% certainty what is going to happen in the market in the future, then you have to use proper risk management. If you knew what will happen in the market, then you wouldn't need risk management. But since we're all human and we don't have a crystal ball, then you're obviously not going to know what's going to happen in the future. And so you would have to couple that with risk management, proper risk management, obviously, okay? So this is an example that I want to use to illustrate my point again, okay? So what do we have here? Well, you can see that on this day, price opened below the central pivot point, which is this blue line we have here. Okay, so what does that have to do with anything? Well, if you're using the approach which I told you I lean more towards, which is to wait for price to react to pivot levels before you take trades, okay, then you would have obviously seen that when price opened below the central pivot, it ended up breaking above it, and then when it broke above it, eventually it retraced. So if you're coupling this with proper market structure analysis, you notice that this was a low, and then okay, let me reduce this because it looks too big. Okay, so you notice that this was a low, and then price made a higher low, and then eventually price was kind of meandering here and all over before it eventually broke above this resistance area to form this high. So if you were to couple this pivot point analysis with your market structure, you would have seen that we are forming the market structure of an uptrending market, which is price forming higher highs and higher lows. And so when we had this retracement, when we had this pullback, it was at the central pivot area. And so when we had this rejection candlesticks with long wicks and all of that, and then we eventually had the formation of this bullish engulfing candlestick, you would have taken a long trade here. With your stop loss, if you're using an aggressive stop loss, it would be right below this area. Or if you're using a conservative stop loss, then it would be below this lower high. Higher low. And so you would have taken this trade, aiming for maybe 1:2 or 1:3 risk to reward ratio. And this would have been a good trade that would have hit your profit target. Now, if you would have used the other approach, where you would have waited for price to reach the pivots or the resistance areas or whatever, because it opened below this area, you would have been waiting for price to come below for you to buy. Okay, and that never happened on this particular day. Does this mean that method does not work at all? Absolutely not. I'm just showing you the facts. I showed you examples of where that approach would have worked, and I'm showing you the other example of where my particular approach would have worked. Does this mean that my approach is going to be 100%? And that's why I told you it's not. That's why you need risk management, okay? So in this case, this trade, let me quickly see what would have gotten. If we would have taken this trade around here at the close of this candle, if we were using the aggressive stop loss and aiming for a 1:2 risk to reward ratio, price would have easily hit our 1:2 profit target somewhere around here. In fact, it went all the way to 1:4. Remember, if you're using this pivot points trading techniques, most times you want to use it intraday. Okay, so intraday simply means you're opening your trading positions within the day, and at most you're trying to hold that trading position to the end of the day or close it somewhere during the day. Okay, you're not leaving your positions to be open for days on end. Okay, and if you are using the conservative stop loss, which would mean that your stop loss would have been somewhere below this higher low, this would have been where your stop loss would have been. And in the same case, you would have still gotten a risk to reward ratio of like 1:2 comfortably, or maybe even 1:3. Okay, so this is this for that. Okay, now let's look for other examples. Okay, let's look for other examples. I think let me go back a little bit so that we can see how this would have reacted exactly. So this was a day where price opened below the central pivot. Okay, now remember, the widespread technique is for if price opens below a central pivot, you'd be waiting for price to come all the way down to the support levels and then you just buy. Okay, but if it opens above it, then you'll be waiting for price to go all the way up and then you just sell. In this case, price opened below, and so if you were waiting for it to go all the way down for you to buy, it would have been way late in the day that would have happened. But if you're using the other technique, which I told you, is to watch how price reacts to the pivot levels before you decide to take a trade, then you would have obviously seen somewhere around the London session, or when the volatility was high in the market, you would have clearly seen that price came all the way to this resistance area, R1, and then it found it very difficult to break above this level. And when you couple this knowledge with the fact of with market structure analysis and all of that, you would have seen that somewhere around here in the previous day, price really struggled to break above resistance and it failed. And so when it tested this level again, it was finding it extremely difficult to break above this level. And so when this rejection happened and then price came all the way down, and then it tried to break above this level again, but it failed to break below the level, above the level, and it led to the formation of this bearish engulfing candlestick. This would have been a short trade setup for you, because when you couple the fact that price is struggling to break above this resistance area, plus the fact that we have another resistance area where price is just, forming kind of like a double top around here, then the formation of this bearish engulfing candlestick, this would have been a clean short trade setup for you. So if you would have taken a short trade at the close of this candle with a aggressive stop loss, which means that your stop loss would just have been, right above this level, right above this candle, then this would be, if you're aiming for a 1:2 or 1:3 risk to reward ratio trade, you would have easily hit that profit target. In fact, price went way beyond that to like 1:6. Okay, we're just keeping things very simple here. But if you're going for the conservative method, which means you're placing your stop loss way above the resistance that price is struggling to break above, which would mean that your stop loss is going to get hit a lot less. Okay, but your risk to reward ratio is going to be impacted in the sense that since your stop loss is going to be a lot further from your trade entry, then your profit target consequently is going to be much further from your trade entries as well. And so if you're using this technique, you'd maybe at most be going for a 1:2 or 1:3 risk to reward ratio. And so again, even if that was the case, you'd have easily hit your profit target somewhere around here. Okay, so there's no right or wrong approach. The reason why I'm showing you all of these techniques is because I'm showing it to you, and then you would decide which one you resonate more with. Okay, so is it the technique where you wait for price to, show you where it opens in relation to the central pivot point, and then wait for it to either go up for you to sell or wait for it to come below it to buy? If that's the technique you want to, awesome. But if you feel like you trust your knowledge of candlestick patterns and market structure and price action and all of this, and you would much rather wait for price to react to these levels before you decide whether you're going to buy or sell at a certain pivot point, then that might be the way to go for you. But even if that was the case for you, you'd still need to couple that with proper risk management, because like I keep telling you, you could have a trading strategy that has a 90% win rate, but if the losses that you incur on average are way larger than the profits that you get, then you are going to still struggle to be able to turn a profit from your trading activities. And so it's not only about, just risking 1% or finding trade entries or exits. It's not all about that. It's about coupling that with proper risk management and also the discipline to take trades, whether you have 5 or 10 or 6 losing trades in a row, or sticking to your plan and not getting greedy when you have like 5 or 6 or 10 winning trades in a row. Okay, so you have to have that proper risk management with a trading strategy that gives you an edge over the market, coupled with discipline to follow that trading strategy, to follow your trading plan to the T. Okay, and so this pretty much brings us to the end of this week's edition of the ITU Forex class. But as you know the drill by now, before we wrap up the class, I would like to introduce you guys to our section of the company, which is dedicated to trading bots and expert advisors, which are meant to trade on your behalf find low risk, high probability trading opportunities for you on your behalf and take those trades for you, and have you earning while you're learning how to trade. So if you're interested, please reach out to us on any of our social handles or drop a comment in the comment section, and we'll be more than happy to walk you through exactly how to set everything up step by step, following our risk recommendations. And before you know it, you'd be up and running and ready to go. So if you're interested, please feel free to reach out to us on any of the social handles. And if you do have a question or anything, please don't hesitate to type them down, and then we'll be more than happy to assist you set everything up step by step. In the meantime, I would like to use this opportunity to thank you guys for taking time out of your busy schedule to come to these classes, and to also, with enthusiasm, learn and from all of the things that we're teaching you. But please, as you're learning, make sure that you go out there and practice what you're learning, because it's one thing to learn and implement, and it's another thing for you to just come to these classes and then just have the things we teach you go through one ear and go out through the other ear without having you do anything. Okay, that's just going to be a waste of time for both yourself and ourselves. Okay, so please make sure that as you're learning these things, you're taking them and putting them into practice and improving your trading performance. In the meantime, thank you, and I look forward to seeing you guys in next week's edition of the ITU Forex class. Thank you, and God bless you. Cheers.